Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
She's more important than the Secretary of Treasury. Constance Hunter joins now from EIU. Constance, you take your inflation guesstimate to 2 decimal points. Can you do that? Can we actually guess to 2 decimal points on a change in inflation?
Well, you bring up a really great point, Tom, and especially with regards to goods, what we've discovered is that we really don't know the price elasticity of demand of a number of these goods that are going to be impacted. So we're triangulating all sorts of different data sources and really kind of trying to get under the hood. But your point is well taken, right? What is even the point of going out to 2 decimal points if you have this level of uncertainty? Nevertheless, we try to be as precise as possible so we can learn from our actions.
Do you see substitution of products going on because of tariffs?
Oh, absolutely. I mean, and I think what'll be interesting to see is again, how price sensitive are consumers once these price increases really start to feed through. Let's remember, we had an extraordinary amount of front loading in the beginning of the year and really at the end of the fourth quarter last year, where consumers pre-bought and suppliers pre-bought ahead of these tariffs, right? And so we're still waiting for that pig in the python to move its way through.
Constance, when do you think we'll see that? Is that something that we're going to see maybe today, or is we're not going to see any inflation impact? If there is any, and a lot of folks say that there may not, is that something we may have to wait till the fall to see maybe in the data?
You know, I think you're right, Paul. I think it's taking a lot longer. And what we see from some alternative sources like Cavallo, for example, which really does work on real-time prices, and they gather information from 4 different retailers. We can guess who some of those retailers are, Amazon, Walmart. And when you think about Amazon and the troves of PhD economists they have working on how to price goods, right? They probably have better information about the price elasticity than anybody else right now in the US economy. And what they show is actually that domestic prices, while they increased in the beginning, have really leveled off. So domestic suppliers are aware of that price sensitivity, I think, and are keeping their prices competitive so that they can gain market share.
Constance, just to get narrow here, 45 seconds. Auto insurance is 3% of our inflation picture. Is there anybody listening who's paying less in auto insurance? I don't think so, Constance.
No, and you talked earlier about all the flash floods and rain that the New York area experienced over the last 24 hours. And that destroys automobiles. If you get stuck in a flash flood, your car is totaled, right? And so we look at the incidence of perils and they're increasing. And then what happens is that gets transferred to the entire auto market, right? Everybody, auto insurers price so that they make up losses in areas where they're experiencing higher catastrophes.
We're trying to give Constance 32 seconds here to look at the...
Yeah, plenty of time.
Constance Hunter with EIU. In the 90-second glance you've had, Constance, what do you see?
Well, it's not showing up in goods, right? If you go to the commodities, less food and energy, you're not seeing it in apparel, which was down month over month. You're not seeing it in new vehicles, which, it was also down. Used cars and trucks have a little more complicated pricing in them. Medical care commodities were up 0.6 month over month, but you're really not seeing it. Tobacco and smoking products are up 0.8, but I don't know if that constitutes a trend. And I don't know how much we import of tobacco.
But the answer is, Constance, before we let you go, I don't mean to interrupt, but this is too important. After hearing from Bessent, then Hunter, the president's going to come out and say, show me the inflation and tariffs, right?
Of course he is. Yes. That is the issue, and the reality is it is not in the current data. We do know, of course, that inflation is somewhat of a lagging indicator, right? If you're a firm, you're going to wait as long as you can to raise prices because you don't want to lose market share. So we just need to keep in mind this is a lagging indicator.
Is there a scenario where the companies actually, by and large, do take it in the margin and we don't see it necessarily at the consumer level? Is that a scenario? I know a lot of folks are suggesting that might be the case.
Well, there was an interesting article, I think it was in the Wall Street Journal from my morning scan of the news, how Levi's is reducing the number of SKUs in order to manage their costs so that they don't have to pass on the price increases, right? So they're reducing the variety of things that they're producing. And so I think firms are really, when you think about the data and analytics that's been deployed over the last 6 years in companies, firms have a lot more capacity to control their supply chain and to control their product mix. And we're seeing some of that productivity gain from those data enhancements coming to bear as firms try to manage through this.
Constance, thank you so much. Just wonderful to have you here. At 8:30 for the National Inflation Report, Constance Hunter with EIU.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We turn to banks. It's been helter-skelter today with the Treasury Secretary. This is a more important conversation for Global Wall Street. Alison Williams joins us with Bloomberg Intelligence. Alison, the way I read it is a complete hack is there's 4 big banks. No. There's JPMorgan, and there's these 3 other banks. Am I off the mark?
Well, there's JPMorgan. I always say covering JPMorgan is like covering, 4 big companies, right? Yep. Or, depending on how they've done their division, I guess it's 3 big companies now. So, really the net interest income guidance very strong. About $600 million upside to the core NII.
The ratios were sick. I went back and forth with Valerie Titel in London. They did a tangible equity of 20% plus. Am I right? Citigroup's half that?
You are right. I mean, if you look at, if you look at Citigroup, it's a very different story, right? So Citigroup is still in a story of transition. We've been talking about that transition, as we say, ever since Sandy built the house. It's been being taken apart. And I think Jane Fraser is making a lot of tough decisions there, and really solid quarter out of Citigroup as well. They're upping their net interest income guidance. Their fixed income trading up 20%. So that's it. That, JPMorgan and Wells were up 13 to 14%. Citigroup has an amazing rates and currencies trading business, as you know, Paul. And that is really where the strength is this quarter. That's where the volatility is. And they are really executing in that business. Again, core net interest income going up for both of those banks. Wells Fargo a little softer, but Wells Fargo is looking at the overall number. Keep in mind that there is core net interest income, and then there's a number that includes trading. And so the trading net interest income tends to be offset in fees. I think from a headline perspective, people are sort of going to be less positive on those Wells Fargo results. Wells Fargo also not getting this huge benefit. So as I said, they saw some growth in fixed income trading, but JPMorgan and Citi much stronger in those businesses. JPMorgan delivering $1 billion of upside in their trading and fee. I haven't done the calculation yet for Citigroup, but the trend's also better for Citi.
What are the banks saying about loan origination? Are they writing loans? We were just talking to Huw van Steenis and Oliver Wyman about private credit. And I just think back to my Chase Manhattan days. We were killing it doing the leveraged loan business, making money up front, making money on the spread, syndicating my risk out to every other bank around the country. What are they making loans these days?
So they are making loans. I mean, the card business, which is probably not your concern back then or now, but the card business is very profitable for these banks, and that's where the loan growth has been. And again, that's benefiting Citi and JPMorgan. We have seen a little bit of pickup in the commercial numbers in in the Fed data. We're going to hear what Bank of America says tomorrow on that. I think with regard to privates, it is a change. But I think if you look at, for example, Goldman's business, so Paul, Goldman, their merchant banking business, that they, back in the day made a lot of money from making these proprietary investments. Volcker rule came along and said, please don't do that on your balance sheet. By the way, investors don't like the balance sheet, right? Because when you make those kind of investments and you're recording gains, people don't really give you a lot of credit because they view them as volatile, et cetera. But you have someone like Goldman who's now said, I'm going to be an alternative asset manager. And now instead of putting my balance sheet at risk, I'm going to, take the client's money. So, and I'm going to earn fees, and investors like that. They like asset management. It's a high multiple business. And so it's a higher return on equity business. And that's been a long-term story at Goldman. So I think the banks are fine. And that's a Goldman specific, but I think all the banks are doing that.
Okay, I want to go to the gossip of the moment, folks. Out in the Hamptons over a beverage of her choice, Alison Williams is getting hammered by fancy people over the reorg under Mary Erdos at JPMorgan. First of all, I'm going to say they're the most successful bank asset manager, the only one really competing with BlackRock and the others. So Mary's built a franchise, and now they're saying geography doesn't matter anymore. The Wall Street Journal had this great summary of it. Explain to us how JPMorgan and Mary Erdos is blowing up asset management, private wealth.
Well, I think that, Mary Erdos is first and foremost thoughtful about the talent across her business and, is consistently talking about the strength they have as an active manager. But one of the more interesting things that Eric Balchunas, as you know, who's the expert on ETFs, has been talking about is that they are really gaining share in the active ETF business. And so that's not your question, but that is something that I want to highlight that I think is something happening over there.
We're in a bull market. They're minting more money than God. And JPMorgan is saying, we got a problem. We got to blow up private wealth management. Why are they blowing it up, and what's the goal?
Well, again, I don't know. I think that Mary Erdos is a very thoughtful leader, and I think that, again, it's sort of like as we're going through the future, we've been through a long period of what we call U.S. exceptionalism. Yep. But I think that JPMorgan has always focused on the world at large, focused on emerging markets, focused on these different growth opportunities. And I think it's just a way. And by the way, JPMorgan, I think, is always, as I alluded to earlier, looking at things differently. When you're a global organization, you have products and you have regions, I think sometimes you have to find a way to focus on both. And I go back to the fact they're very focused on talent. And I think that, they're thoughtful about the way they run their business.
We're seeing so many good results coming out of these U.S. global banks. It just makes me think next week we're going to hear from the European banks. And they're just nowhere relative to where the U.S. banks are. When will Europe say, we need to allow consolidation here? They fall so far behind every single year, it seems. Is that not an issue for them?
They do. And I think the biggest change, Paul, over the last, let's call it decade or a couple of decades, right? Time flies, is that, first of all, the U.S. has benefited from a virtuous cycle of having sort of a better economy for a long period of time. But really, they've benefited from the virtuous cycle of investment. They had the money to invest. They invested the money. So that's led to better revenue, better market share, et cetera. Whereas I think for the Europeans, they tried to sort of cut their way to profitability, and that ended up, as you know, investment banking and trading, these are not businesses where you go bargain shopping, right? And so I think that they didn't invest. That hurt them. They've had to exit businesses, et cetera. But it's difficult because everyone agrees we really should consolidate, merge some of the benefits together, but no one wants to be the seller. Everyone wants to be the buyer. Everybody wants the champion in their home market.
Come on, there's a price.
That's the difficulty.
A price. Are we at the point where the shock of that later this year, quickly here, Alison, is we get one big industry roll up because they find price, and as the sellers say, enough, let's go?
I mean, we could have had this conversation
14 times.
A million. I just think that those political sensitivities, it's very difficult, and it's hard to say whatever would change their mind.
Okay, what do we see tomorrow?
Things that make sense on paper, politics get in the way.
10 seconds tomorrow. Goldman Sachs, Morgan Stanley, they do better than good?
Based on the trading and fee numbers we saw today, based on all the trends we saw in the quarter, we think that it's going to be a solid quarter for trading. We're going to want to hear what their CEO clients are saying with regard to the investment banking pipeline.
Thank you so much for this brief, particularly on where we are on the reorg of JPMorgan in private management, and of course over to the other banks, and particularly Citibank there.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're going to get to private credit here with Huw van Steenis. Paul's going to bring that in, but I got to first do an audible here, folks. It's a surveillance audible in a 2-hour conversation with Huw van Steenis. You go, okay, where'd this guy come from? And it's not Oliver Wyman or his work with the Bank of England with, at the time, Governor Carney, or he did this as UBS, da-da-da-da-da. Years ago, like think Queen Anne, Huw van Steenis was at Morgan Stanley, and he was absolutely definitive on EU finance. Joining us now with Oliver Wyman, Huw van Steenis. Audible, I saw the French Trésor, not the Haute, Huw, the Trésor roll over yesterday with acceleration. How fragile is French debt given Mr. Trump's shenanigans?
Oh, Tom, thanks for having me on again. Look, I think there's a lot of pressure from investors on the French situation. A lot of fixed income investors are struggling with the lack of debt consolidation. And look, let's play the history here, Tom. I think the French throughout the last 30 years have somewhat struggled with reining in public debt. In fact, if you go back to 1981-83, actually Mitterrand had to do a huge pivot because he just wasn't controlling the public debts back there. And so I think there's real pressure here. And look, the fact the spread's already trading outside Portugal and Spain, and there's a lot of debate about whether they trade outside Italy and Greece, tells you how stressed and how nervous folk are.
The jargon, he's all jargon. I mean, he was at the state dinner, and he brought the conversation to a halt. With his jargon. What he's saying there is French credit's trading worser, folks, in Portugal, Greece, and all. Here, one final question on this. I'm beginning to see real yields, inflation-adjusted yields in Europe come up as well. Can President Trump, with his tariff debate, pull up EU real yields to bring Europe to a standstill?
It's a great question. It's certainly possible. I think, look, isn't the issue with tariffs at the moment that the short-term pain is not there, and it's a question more about how it impacts investments and the longer-term business. And just like you've seen the resilience in the States, you're seeing real resilience in European earnings, and particularly the opening of the fiscal debt. So I'm not sure that it would necessarily drag it up immediately, but I think that tension over a 1 to 3 year period, that's where you're going to start seeing, is there going to be more friction in the system from lack of competitiveness? And let's hope certainly by then we're going to see a deal. So I'm not as convinced on that, but anything's possible.
You were starting to hear from the big banks today, and one of the areas of questioning for the banks will be kind of how they view private credit vis-a-vis their core lending business. How do you guys view what has been just a phenomenal growth story on global Wall Street, which is private credit?
Oh, look, so I think the private credit train continues, and as we've discussed many times, that sector is growing 20 to 25% compound, because it's not just about leverage lending and mid-market lending. It's also now about replacing investment grade, either through asset-backed lending, so sort of like private securitizations, or it's going for these jumbo deals, these really large, complex deals. And under current bank regulations, if it's risky, if it's very large or very complex, it goes to the private markets rather than the public. So I think there's two games here. I think the first is the banks are clearly fighting back And you saw the news from one of the big banks yesterday, which you ran, showing a new group to try and come up with solutions for more complex deals. Maybe the bank takes part, maybe it slices it up and gives part to private credit, but the banks are very much back. But I think the other story, and I think you'll see it through this earnings season, is banks love steep yield curves. And so the net interest income for the banks, I think, will continue to beat and beat and beat, because these steep curves will translate through to higher earnings. And therefore, even though they're ceding ground to private credit, the core engines are still doing really well.
So, Huw, for the private credit business, are there opportunities for retail investors to get exposure to this asset class?
Yeah, well, this is a great question. So we've been digging into this. So there's been a 2.5-fold increase in the investments by wealthy in private credit in the last 3 years. That's 4 times faster than from traditional institutional investors. And we think something like $350 billion, or about 12% of private credit assets, now come from the wealthy. Now, the wealthy, though, is still it's the ultra wealthy. And one of the biggest areas of innovation in partnerships and new products is trying to think about expanding this to a much broader range of clients through, evergreen funds. And, just one stat, evergreen funds are probably the single fastest growing part of the investment universe at the moment. Interval funds are growing 70% from a low base. So I think this is an area where there's quite a lot of room to run from here.
With us, Huw van Steenis with Oliver Wyman. He's too modest. Let me put it to you. It's a really, I hate him. There's a 21-page document. Oliver Wyman, Private Credit is Reshaping Wealth Portfolios. Get it through Oliver Wyman. We protect the copyright of all of our guests. Huw van Steenis, Ben Phillips, Laura Watkin, and Parth Agarwal as well. What's the risk factor here, a wise one? Is it too much money chasing too few private credit opportunities? Is it the credit quality is going to go down? Is the IRR going to... See how I did that? It's impressive as all get out. Huw, what's the major risk factor here?
Look, it's great. Well, look, I'd say so. Near term, the biggest threat is just too much money chasing, and credit spreads continue to compress and compress. And look, we've already gone from, if you were trying to buy a single A private credit bond 2 years ago, you might be getting 2% more than a public single A. Last year, it's probably 150 to 175 basis points over. Today, it's probably only a point. So it's probably the excess spread is probably halved in less than 24 months. And so there might be, if there's a lot of money coming through, so therefore the constraint is really about originating more assets. And so you're seeing more deals with private credit team up with banks for partnerships, but also looking to generate their own assets. And I think that's the gate for me. If they don't originate enough assets, then the spreads will compress. I think longer term, clearly there's always going to be a credit cycle, and so that, and there'll be some good decisions and bad decisions. But I think at the moment it's the weight of money.
Huw, I mean, the dollars are getting just really substantial there over the last decade or so. We're starting to get more and more retail exposure there. Does there need to be some type of regulation on the private credit business, do you think?
So I think it depends what kind of regulation. So I don't see this sector as systemic. I mean, let's remember, banks get regulated partly because they hold everyone's deposits, but also they're very leveraged. And so when credit leaves a bank, which maybe is 10 times levered, maybe going to an institutional account, which may be 0 to 1 times levered, less leverage means it's less risky when you hit a speed bump. So I don't see it systemic. But the more you put private credit into retail portfolios, the more that then the SEC and regulators looking at the products and protecting investors will need to think about, is this the right product? Right. Have we got regular marks? And I think we discussed this last time I was in New York, the pricing conventions. So the way you think about pricing private credit, you can't just do it once a quarter. You need to do it every month, and if not more frequently. So there's a lot of regulatory stuff which will need to play catch up.
I promised Dan Tannenbaum I'd read your private credit report. Huw, I'll get a PIMS in my hand and read that this weekend. Huw van Steenis, definitive on private credit with Oliver Wyman.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
We're not going to turn this into a history lesson, but the bottom line is that LSE in the 50s Karl Popper sat with a young student named George Soros and said, the way we think about history, the way we digest past tense data is maybe not as productive as it could be with something called reflexivity, which is a different approach. If AI is about a large language model data dump, how are we going to move artificial intelligence onto what Soros and Popper were talking about?
That's a great question. First of all, thank you for having me on the show. I think as what we're seeing currently, what is really exciting about the technology that we're witnessing right in front of us is that it has this capability to digest huge amounts of data and start to make sense of it, help us make sense of it. And I think that we have always looked to the past to try to understand the future because that's the only data that we had.
Right.
And what is different this time versus before is that we seem to have been accumulating more and more data, but didn't have increased bandwidth to process it. In my mind, AI is going to resolve this.
Okay, AI is going to resolve it, but it's just nothing more than a richer, deeper backtest. Everybody did backtests on a difference equation. We went back to T-1 or T-20, whatever. Is AI going to change how global Wall Street, the pros listening to the show, how they backtest?
It is going to change it because actually I'll let you know that the experience that we have had, so Reflexivity platform is used by a number of top hedge funds. And what we have found as they start to incorporate this into their workflow is that they are amazed by the speed with which the system is able to answer their questions by going straight to the data. In fact, often they run out of questions because you are not used to being able to tap into the data so powerfully and so quickly. And so we seem to now be limited only by our imagination. So the way I think about AI helping investors on Wall Street is giving them this superpower where they can keep thinking about scenarios that could unfold and have the AI back that up or dispute it through the data. It's a very objective arbiter.
Can you give us, and this is so new to so many of us, our listeners, our viewers, what is a typical query that you would get from an investor client that maybe AI could be helpful with?
Well, it started with things that were extremely basic in nature. Somebody might just say like, oh, I'd like to really understand if when somebody talks about the inverted yield curve, how accurate has that actually been in predicting recessions? It then became a lot more complex when you might say, look at all of financials for a specific company, be it Tesla, Microsoft, JPMorgan, whatever. Tell me what is the market not appreciating? And suddenly it's pulling together things it's able to glean from analyst reports, news outlets, and financials and say, well, actually, here are some parts of the business that are growing extremely fast, but get no mention from the analysts. And so you could have a re-rating. The dream here is that, and this is what reflexivity purports to do, is if you were the first to know that AWS was going to be a big deal for Amazon, you would have made a lot of money.
Wow. So this is such an amazing part of the investment process. How are your clients using it today? I mean, how is that evolving? Because I'm assuming this is an education process for some pretty smart investors, some savvy investors, but maybe they don't understand the logic behind artificial intelligence. How are they using it today, and how do you want them to use it?
Honestly, our first advice to the pioneering clients that come to us and start using it, and there have been an increasing number in the past few weeks, is just dip their toes into it, try it. I think trial and error is very important because I think working with AI is unlike any other software that you would have used before, right? Where does it get data? How does it calculate? How does it reason and so on? Once you get the hang of it, however, it becomes extremely exciting and you can see people just get engaged with it.
Okay, you grew up in the milieu of Harvard, MIT, and all the fancy people up in Boston. Black-Scholes came out, and I never met Fisher Black, to my great regret. He died tragically early. But what a joy I've had in discussing Myron Scholes and picking up the pieces of 1998. How does a modeling that's new, wrapped around reflexivity, how does this tested model work given substantial leverage shocks, the discontinuities that are brought out by leverage as a pro would use?
So again, I think here, the calculations that the system will do fall back on the traditional statistical methods. It's not reinventing the way you're calculating things or the way you're calculating correlations. What it's able to do, however, is understand the analysis that you're trying to achieve
Right.
and then potentially do that analysis in 3 or 4 different ways.
Which side of the log normal curve is this on? I can see you were Schleifer and Rogoff in some PhD ballet going Gaussian to log normal to Poisson distribution. On a vanilla log normal distribution, Colin, I'm doing this for you, it's jargon. On a log normal distribution, the short side's more difficult to manage than the long side. Do you get better alpha pickup shorting the market versus a long market?
Actually, I think it's quite symmetric. It's true that generally when you look at how investors perform in buying versus getting out of positions, they're generally worse at getting out of positions. They're quite good at picking them, but not so good at getting rid of them. They typically do it when they have to. So here the AI can be helpful because it's able to actively, this is what reflexivity does, spot something in the market. Let's say that interest rates are starting to move much faster than they have been. And it'll point to your banking stocks and say, you should pay attention to this because it could be that there is a lot more downside risk than you realize.
This is great. Thank you so much. Jan, please don't be a stranger. Jan Salagi with us with reflexivity. This is a tool that's being used for a lot of sophisticated investors to get out front to create an edge. His work in academics with Ken Rogoff at Harvard is noted.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Out of newspapers. It's a truncated version. She came in a little parched, I think. I mean, wet, I should say. After the floods yesterday. Lisa Mateo Trooper made it into work today after serious floods in New Jersey. What do you got?
Okay, Paul, you still have that big European trip coming up, right?
Yes.
Okay. So this one's for you. I saw this in the Wall Street Journal. It stood out. American travelers have less buying power this summer because of the weakening dollar. So the Wall Street Journal said the dollar weakened 13% against the euro this year, 6% against the Japanese yen. But the thing is, it's not stopping travelers from booking trips, as you know. People say they just might buy less while they're there.
Probably.
I don't know if you plan to buy less while you're there.
Well, I might go down a little bit lower on the wine list, maybe when I'm in Italy. I might not go for the highest end, but we'll be fine.
Yeah, and then they also point out too, on the bright side, it's made kind of exports cheaper, open up opportunities for Americans to invest in those foreign stocks as well. But an interesting take on the weekend.
And I'm hearing, you hear from the airlines. I mean, the airlines took up their guidance and reintroduced their guidance, saying that the air travel is strong, including U.S. to Europe. So, if you talk to our friends in London or Paris, they're like, there are Americans everywhere. Like, I'm not sure they're happy about it.
I mean, I'm looking at the Bulgari menu at La Terraza, the deck there overlooking the famous new monuments that they just reopened. The Carpaccio di Spignola on Aglio Limone.
Oh boy.
I can't read the rest. 22 euros. I mean, that's what you expect at the Bulgari. That's going to cost you a couple dollars more.
I know, it is, but we'll be there.
But do you cut back on the souvenirs? Maybe you don't get presents for everyone.
Right, exactly.
Maybe that's the thing.
There's a gauntlet. You come down the Spanish Steps, and there's a gauntlet of souvenir stores called like Gucci, Hermes, Prada. It's a gauntlet. That's a souvenir
That's where they get you.
You're looking at. Next.
Okay. Starbucks corporate managers who are working remotely currently, they're going to have to pack their bags, relocate. They have 1 year to do it. They have to go to Seattle or Toronto within 12 months. So they put out this back to Starbucks plan. Corporate employees are now having to come back 4 days in the office a week, up from 3 days starting September 29th. But what's ironic...
3 days? They were still on the 3?
I know. They were still on the 3 days.
I put the surveillance cork in my mouth.
Yeah, exactly.
But the thing that was ironic to me, too, was that Starbucks CEO Brian Niccol, he wasn't required to relocate when he first started. But the company says he does have a residence and an office in Seattle now.
Good for you, buddy.
So he has come back.
Are
we still doing that?
Are they doing well?
I mean,
no, they're not. The thing is, sales. They posted 5 consecutive quarters of same-store sales declines.
I mean, the stock has gone nowhere during the pandemic, essentially.
He's trying, they're trying to overhaul the cafes, make them more welcoming, trying different things. But I mean,
I have seen a change. I mean, they're actually writing on the cups again.
Yes.
Oh, really?
Yes, that's big. Putting a little smiley face on. I am a sophisticated analysis there. So, it's not just, but people are just, the drive-through line is out and there's nobody in the store.
I can tell you at Ellen Ducasis Benoit, they're not writing on the
exactly.
What do you got next?
The next one, You're going to have to help me with this, okay? So the NCAA, right, they want to expand March Madness, but the tournament might not be enough to pull in more money by growing it. So they have another option on the table, and that is going to booze. We're talking beer, wine, alcohol. These are things that the NCAA has kind of steered away from. But here's where it gets a little confusing for me too, but the NCAA can't sell those sponsorships themselves. So they have to persuade the broadcasters, CBS and Turner, to do it, and then increase their own annual payment to the NCAA. So it's this weird position that they're in.
So we're going to have, Paul drinks Budweiser, folks.
Yep.
The 17-year-old new superstar Duke has to have a Budweiser lapel
I can't imagine.
Patch on his
So
uniform.
I guess CBS will, start taking ads for booze and stuff like that. They're on NCAA. I don't know.
Yeah, it's weird because they're tied to this contract through 2032. Fixed payments. So,
but I think they're going to expand the NCAA, the March Madness, to like more teams and everything.
Really?
Yeah,
they're going to go beyond 64 teams?
They want to go to 76 was what they're saying from this article. But
well, that doesn't, Paul, help me here. That doesn't sound like a dumb idea. It's not
I don't know what the right number is.
Like the NHL or MLB, but just more teams.
I guess.
Does it make it any more exciting? I think it kind of waters it. I don't know.
Yeah, I like it at the beginning. Am I right? Well, I like it at the beginning of the tournament because I haven't been thrown out.
Right.
I never watch the Final Four because I don't have any
nothing
of the
in there.
picks.
But that first weekend is what it's all about. You get all the teams playing, and that's what makes March Madness great.
Lisa, you're gonna be able to get home. We got rain tomorrow, rain Thursday.
I just got to keep checking my sump pump. I go to the basement and I keep
still
checking,
working?
kick that thing, make sure it's still going. So
Lisa Mateo, the newspapers, thank you so much this morning.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.